to, focus on future, decision making and current decision making instead of looking to the future and what's happening now. Because it takes a while for that stuff to take effect, right? Like if you do a Fed rate hike and you're trying to see how it impacts the economy, it's going to take a while. And it's going to take a while to get that data to even look at it. So all the decisions they're making now is based off past data. So that makes it really hard. And most likely they're going to overcorrect once everything, plays out. They're going to overcorrect on curing inflation. But anyway, so everyone kind of views those statements by Jerome Powell in the Fed with a fine-tooth comb, just to kind of get any inclination of where their head's at. That's why last time when I said people should pay attention to, the Fed should pay attention to what they say, because it really impacts things. It matters. The bond market's paying attention to it. And so anyway, they were looking at that. That came out at 1:30 today, Central Time. And unfortunately, Powell was saying, no, they're going to continue to be very strict and continue with strict policy when it comes to reducing inflation. So people are inferring from that, okay, then the next rate hike on December 14th might still be 75 bips and not 50, or they're going to continue after that and not take a pause to kind of see how this impacts everything. Give it a little bit more time to see how it impacts the economy. But he did say that they are going to start taking into consideration the lag time. And that was something that was positive, but everything else so outweighed that statement. So as of right now, the bond market didn't take his comments favorably, but we'll see what happens tomorrow, in case overnight people are looking at it a little bit more, or what most likely will happen over the next week or so. Other Fed members are going to step up after they see how these comments affected the public, and just come out and maybe have their own spin on it, like, oh, no, never mind. We are going to just do 50. We still might wait. We'll see, because that happens from time to time, just depending on how the information was taken.
So welcome to Real Media, by the way. Sarah started talking. I was like, forget an intro. Let's just have Sarah keep talking. So welcome to Real Amigos. Ian had asked Sarah kind of what's new. He was just like, what up? And Sarah just started rolling into it. And I'm like, might as well put this on the channel. So welcome everybody. Welcome Dinosaur D, Papa Powell, reining in the inflation. Yeah. So Ian, what's up, man? How are you?
I'm good. I'm interested to get into this because of like what Sarah was saying. They had an announcement today, and I think that's going to affect a lot of what our buyers and our sellers are thinking. Not necessarily that it should, but it will. So I'm excited to hear more about that.
Yeah. So Sarah is back on the channel once again. We were supposed to have Jason Walter today as well, but he woke up with the flu that Ian and I had last week. So maybe we'll get Jason Walter on next week. But so Sarah is the reigning lender, and she's done a lot for the channel. So Sarah, if you want to real quick go through, say hi, and then talk about kind of what we're doing with rates and what's going on.
Yeah, of course. Hi. I'll make that short. Hi, everyone. So basically today was a Fed day, and I know everyone jumped on when I was kind of going through it. So sorry, I get nerdy and I start going on tangents a little bit because I get excited. So I apologize about that. But it was a Fed day. Fed increased the federal funds rate by 75 bips, which was expected. That was already priced into everyone's rate sheets because it was something we knew was going to happen. So that's not news. They just did exactly what we all thought they would do. The main reason for the Fed statement is that they have after, the commentary after they announced that Fed rate hike. And basically everyone hyper focuses on what Jerome Powell says to see where the Fed's head's at. So right now, the bond market was not happy with what he came out and said. It basically was like, yes, we're going to continue to be strict with the rate hikes. So we're not, as of this time, he didn't give any inclination that there will be a pause after December's rate hike or that it would be lower than 50. And as Jeremy has on the screen now, if you want to look at what the average interest rate is, I mean, we're in the set for a 30-year fix. We're in the 7s. If you're looking at conventional, 20% down loan. And then if you're looking at 15% or 15% down, we're looking at about like a 6.64%. And if you're looking at like a 10-6 arm, the national average is about 7%. So, I mean, we are in those higher ranges with interest rates right now, depending on the individual and what type of options and credit score they have. A fixed rate may still be more advantageous than an ARM. It just depends. I've seen it go both ways, where some people save a lot of money on an ARM, or they can get a better rate on or the same rate on a fixed rate product. So it really depends. Everyone is so different, and there's a lot of things that go into calculating rate. But on average, we are seeing rates in the 7% and upper tier and the upper tier sixes for purchases right now.
Well, so let's talk about that. So, I'm starting to see a lot of, Ian and I were talking about this before the last, the last Real Migos. We've seen, and obviously the market's seen this, a huge decline in buyers in the market right now. And when we're talking to most buyers, a lot of them are scared. They're like, hey, I want to wait till next year. And like, rightfully so. I think, if you're looking at rates at 7% and you're worried about, how long you're going to have an interest rate for 7%, we've criticized the talk of marry the home, date the rate. Because, I don't feel, if rates go down, then that's great. But if they don't go down, you're screwed still. Anyway, so going to that point, but I'm starting to see a lot of realtors put out videos talking about 2-1 buy downs. They're talking about different loan options, buying down the rate. And I think there's a lot of, I don't want to say misconception, but there's probably a lot of half truths about, what these, things look like, right? Mm-hmm. So walk us through, if you're a home buyer right now and you want to try to get away with not paying 7% interest rate, and you're in the market and you're like, look, I need to buy, what are some suggestions that you have on the lending side that some people should probably really listen to as far as rates, buying down rates? Should they do a 2-1 buy down? Should they do some of these things? And what are the costs? Because I think a lot of people, we're looking at, I did a video this week talking about new construction, and there's builders going, oh, we'll give you 4.99 interest rate, but how much is actually that's getting bought down, and what's the actual cost to buy that down? So if you wouldn't mind jumping in on that.
Oh, for sure. So, and those are all really, really good points. And I think it's very important with where the market is right now. So I would say that if someone is looking to have a less than 7% interest rate on a home that they're purchasing, there's a couple avenues you can go, right? There's buying down the interest rate. So what that means is that you're spending money, extra money that is collected at closing to get a lower interest rate. So you're paying for it. You're paying to have a lower interest rate. That can be something that you yourself pay for as a buyer. It could be something that a seller pays for, a builder pays for, or you could possibly get like a lender credit for that. It just depends. So another option would be the buy down, the temporary buy down. So unlike a regular buy down, we have the temporary buy down, which you've seen a lot. I've even seen it. I've seen a lot of people promoting this. And so this is also still banking on refinance opportunity. I think that's what everyone has to realize. So the temporary buy down can be a great opportunity to lower your monthly payment now and have your monthly payment at a lower determined by a lower interest rate now. But the end game is that there's definitely going to be a refinance opportunity, and you'll be able to refinance this later, because you'll still have that interest rate. So let's say that you were going to get a 30-year fix at a 6.99, and this is purely example, okay? And then if you do a 2-1 buy down, that means that someone is giving you, or someone is going to set aside a deposit, which is almost like an escrow account of money to cover the difference and what your payment would be at the lower interest rate and the 6.99. So a 2-1 buy down, that means for the first year, your interest rate, your monthly payment is going to be based off of a 4.99 interest rate. So that means that there's an account set up where it's collected to make wherever that difference is in payment, it goes into that, and that's how it's paid. So if you're doing 2-1 buy down, and let's say your locked in rate 6.99, that means that your first year it's going to be 4.99, your second year it's going to be 5.99, and then your third year it's going to be back to the 6.99 for the rest of the loan. So you're banking on the fact that you'll be able to refinance this loan into a lower rate within that period, so you can go down to a lower rate. So I think if anything, it could be a good opportunity if you feel strongly there's a refinance opportunity within the next 1 to 2 years. Or if you know that you're in the type of position where you're going to have larger commissions or bonus, or you have a job type where you're going to be making more income, where you're not okay now with that higher payment, but you will be over the next 1 to 2 years, and you'll still be comfortable when that goes up. But otherwise, I think that, that's really important to take in consideration, because some people are like, ooh, 4.99, like I want that, but without thinking that, being like, hey, this isn't permanent. Let's make sure that we know what these payments will be down the road and we're still okay with it. Kind of going to what you were saying about date the rate, right? Marry the house, date the rate, your comment there, that kind of also applies to temporary buy downs even more so, because we have to qualify you for the higher amount. So it's not like you're going into a loan where you can't qualify for that higher, like in this example at 6.99, you can. But there's a difference between qualifying for something and feeling comfortable with that payment, which I think is what you were hitting on earlier, right? So
I feel like if you're doing that, dating the rate at that, like every year, it just gets worse and worse. It's like, oh man, this date really sucks by the time you hit the third year. Like you're dating the wrong way. You should be dating for hotter, not.
No way, man. That's when you put a ring on it. You're like, I'm keeping that.
Yeah, can I just put a ring on it at 4%? Sorry.
Isn't that what rings go for?
Yeah. three months of salary, right? But yeah, I mean, so those are the different ways that you can work. You can try to get a lower interest rate now if you are looking to buy. The other piece is that I think is really important when you're talking about those incentives. You talked about, hey, there's builders out there saying, we'll get you this lower rate, the builder lender, or they're giving all these incentives. There's caps to those. So even though, and that's something that I had to bring up to a couple of people, because if you're getting, let's say that you're only putting 5% down on a conventional loan, you can only get up to 3%, and it's called an IPC, but it's an interested party contribution. So you can only get up to 3% of the sales price from the builder or the builder's lender. So that can get pretty high, because the temporary buy down, you can average that for a 1 year, it's going to be about 0.78 points of the sales price
for a 1 year buy down.
Yeah, for a 1-0 buy down. So because it depends on the loan amount and on the interest rate and some other pieces, but that's for 1 year. So you can kind of double that for 2 years. But that's quite a bit. So if you're doing that plus, other things, you have to make sure that they're not promising more than they can give you at the end of the day, because that's not going to get reconciled until your CD at closing. And then that's when they go, oh, when title and the closing department are looking at, they're like, oh, well, we had to take off some of these concessions, which are seller pay closing costs, builder pay closing costs, because it goes over the cap. And so that's something to keep in mind too, because it's not like, oh, I can get all of these. And that's in your contract, but it's just something that a lot of people don't know to look for or pay attention to.
Yeah. So when you're getting, you notice that you're going to get 20,000 towards closing costs, and if you're only putting 5% down, then what you're saying is that even though the builders say they're giving you 20,000 towards closing costs, they really can't.
Mm-hmm.
They can only.
It depends on the sales price, but yeah.
Okay. So if somebody's going to do that though, and let's say it's a $500,000 house, and they want to do that 1 year buy down. So it's 0.7% of a rate.
It's about, about 0.78.
How much does that actually turn out to be that you have to pay down the rate?
So if you're if you're doing the temporary buy down, it's going to be different than if they actually buy down the rate. So if they just want to buy down the rate permanently, is that what you're asking, or are we just buying it temporary? Okay. If they want to buy down the rate permanently, that's going to depend on whatever the market is doing that day. So it's kind of like how pricing fluctuates with the market, like mortgage rates fluctuate. So does the cost for the rates.
Well, let's say 7% today. So we have factual numbers, right?
So if the 0.78 is what on average the temporary buy down is for 1 year. If you actually want to buy down the interest rate, it can be anywhere from like 0.1 to a point. It just depends. So how much, and that's something that also goes into effect with what your DTI is, what your credit score is, because that's the pricing module is based off all of that, what type of loan you have. So I can't just give like a flat out answer. I'm sorry, but
you have a 740 credit score, 30% DTI.
Call it 40% DTI. That's
Okay.
probably more real estate.
I'm
40%.
gonna price-
Hey, I'm
Let me
thinking
price that
student
out over
loans, I'm thinking
here. Well, I priced that out over here to give that answer. You can move on. You can talk about something else, and then I'll pop back in with the answer.
Yeah. Ian, one thing I think we talked a little bit about last week, and I want to get Sarah's take on this. I want to get your take on this. We talked about this last week. So you have like CNN and is reporting, and I think they got this information from the Mortgage Bankers Association, which is the MBA, which is a lot of the statistics that I was just showing you comes from the MBA. But they're saying that interest rates could be 5.4% next year. So if somebody is trying to, maybe negotiate on a property, get, 40, 50 grand off and buy down, a temporary rate for a year, right? If prices do go down, then wouldn't it make sense, or not prices, but if interest rates do go down, don't you think it makes sense to just do like a 1 year buy down then, or something like that?
Yeah, maybe like a 1 year buy down, and then try to lower the sales price some and get the double benefit in case the rates don't go down or the prices don't go down. That way they're double dipping essentially.
How realistic do you think that, Ian, how realistic do you think it is that interest rates go down to 5.4?
5.4 was my guess. Remember, we were talking about by the beginning of next year. That was my guess. But again, it's all a guess. It's all speculation, just like theirs was. But it's based on some semblance of data. Like, well, we know 3% was unrealistic, and we know 7% is where we used to be, but nobody likes that. So generally, there's some kind of parity where it's right in between the two. So, that's my guess. And they said the end of the year.
Yeah.
And even Sarah was talking about overcorrection. And I think that's an interesting word because, we've talked about that a lot too. I think I wanted to get her opinion once she has the time on what she thinks the overcorrection means, because you hear that a lot. You hear that the bullwhip effect, you hear the overcorrection.
Yeah.
So I'm curious what she thinks that means. What was your number? 5.6?
I said we'd end the year at 6. Is what I said.
Yeah. So, and that either one could still be right. Like we're not at the end of the year. We still have 2 months.
All right, Sarah, you come up with good numbers.
Yeah. So if we were doing like 500K, 740 credit, 30% DTI, 5% down, right? That's what we were talking about. So if you could spend, so like for a point, you could get like a 6.75 for a 30-year fixed.
And how much is that cost?
So that would be $4,750.
Okay, so 4,000. So another 5,000. So if let's say you got the seller to give 5,000 towards closing costs, that would get you down into the 6% range. What did you say? 6.75.
Yeah.
Okay, and on a jumbo. So I would just do a jumbo loan right now because jumbo is the cheapest, but not everybody's gonna do a jumbo.
Yeah, not 500,000. Right?
Yeah. So okay, so you're looking at, for buying down a rate, you're looking at roughly $5,000. Could be more depending on the scenario, but
could it scale to be like the 1% of the property value, or?
So so the point is based off the loan amount. So and not the sales price or the property value. So it's always going to be based off the loan amount. So whatever that is. So if you're putting 5% down, then that gives you, $475. So it's me 1% of that. But yeah, the higher that loan amount is, then the higher that amount is that 1 point is going to equal out to. Is that your question?
Yeah, that's great.
Okay.
Yeah, that's great, because we didn't factor that in when we were doing the calculation. We didn't say was it 5% or was it 20%? Was it getting help from the builder? Because that's another thing. I've had many buyers that say, well, can we just like I think Dinosaur D said, can we get a lower house price and get them to help us with some of the closing costs, right? And then you have, if it's not a new construction, if it's a resale, then you have to think about potential repair costs. And there is a cap for all of this. The sellers can only contribute so much when it comes to proceeds. After that, it just has to be price. And so that's a really intriguing conversation. And they're not going to want to lose all their money, so all their equity.
Exactly. I mean, I've seen a lot of negotiate. Oh, sorry.
No, good. Yeah, you still want negotiation. Go ahead.
Yeah, I've just been saying there's been a lot of great negotiations lately. Like I have 2 buyers closing this week that They got all their closing costs covered, and one, was eligible for down payment assistance, and that does still exist, but no one's really done it in a long time because of how competitive the market was. And he's not having to bring anything to closing. He's getting money back. And I haven't had that happen in a long time. So
which loan type is that? I know down payment, but is it T-Shack? Like which one?
So this one that we used for him was TDHCA, and it was with an FHA loan.
FHA loan.
Mm-hmm.
And then when we looked at FHA, we're looking at, let's see, the moving average right now for FHA is FHA 30, we're calling it 6.68. So
FHA is usually a little bit less. Our government loans are usually always going to be a little bit less than conventional loans on pricing.
Got it. Okay.
But still with the PMI. So
yeah. I want to get your take on this. Patrick Bet-David runs Valuetainment. He's really gone after realtors and lenders recently, basically saying like, if a home is worth $1 million and the rates are this high, that you should be offering like $700,000. Like he's like really like saying that you should be dropping prices. And he's also keeps saying that we're going to 10% interest rates. And he's saying all realtors and then lenders are going to lie to you, whatever. So that aside, I do still find it funny that he works in insurance and they are impacted by the housing market. So it's kind of funny anyway, like just the way he like comes after realtors, like you're in a service industry, dog. Like,
I think some of it sensationalism.
Yeah, of course, he's going for clicks. But my question, I guess, more all, and for you in the chat as well, is do you see 10% being an interest rate on the horizon? I mean, he's using some. I find it's interesting, like how he's pulled data on a few things. Like he basically, like, oh look, foreclosures are up 700%. Like, oh my gosh, like you're missing a lot of context when you say things like that, right? But I just want to get, in the chat as well, what do you think the likelihood is that we do go to 10% on interest rates?
I do want to comment on that for a minute, though. I think the fact that you have all of these realtors, lenders, everyone in the industry, just really taking a moment, taking a step back and thinking about it, how many people have I said, or have I heard say that they think the rates are going to go up? Very few, if any, other than someone like him who has a huge audience and can gain something from it. And when I think about why I would say that, it has nothing to do with whether or not I want people to buy. It has more to do with what I think would be healthy for the economy to rebound. Right?
I guess my take on something like that is if you're telling everybody the rates are going to 10%, so deep cuts are still coming, the way I look at it is this. Okay, yes, you might be paying 10% for a loan. Let's say right now, I mean, the Austin numbers have come down. We can look at that in a second. But let's say right now you can buy a home for $500,000 at 7%. Maybe you get a buy down, maybe you get a 3-1 buy down like Sarah's talking about. You're going to get a lower rate and then if you wait for prices to come down to 450 and buy a home at 10%. Now, I'm not telling everybody to run out and buy a home. I'm just saying like, you have to look at it both ways. You can't just say, okay, yes, prices are going to 10%, hold off and don't buy. But if you're buying a home at 450 and the interest rates, is 10%, you're going to have to wait a long time for those rates to come down to 5 point whatever percent to refi. Even though you paid less for the home, you're paying a shit ton more in interest rate that doesn't even go to the mortgage of the home. It doesn't even buy down the PTI. Or PITI. So I hear people say all this, but on the flip side, like you can get yourself in trouble if you wait. So I'm not telling everybody to run and buy, but what I'm saying is like, you have to do the math for yourself, right, Sarah?
Yeah. I mean, it has to make sense for that individual and what that plan is. Definitely. But I mean, honestly, I wouldn't say, hey, everyone go buy right now either. But I do think it's a good time to buy just because there's so much more negotiating. And I've had so many buyers come back that had buyer's fatigue that now can make deals and can get those seller paid closing costs and do have more opportunity. And I just think about the buyers from last year that wanted to wait because rates just started going up a little bit, right? And they were in the like mid 3s and they were like, oh no, I want to wait till they go back down again. And then look, they waited and look where they're at now. So if you're in the camp of rates are going to go up higher, right? Then it would make sense to secure an opportunity now, before that happens. So it doesn't, screw up it doesn't limit your amount you can buy, because we don't see housing prices coming super down, right?
Yeah.
So
Not yet, but
like they've come down a little bit, I guess, from their peak, but they're not in Austin anyway. But I don't see them coming down enough where they could buy the same home at 10% interest rate that they could buy today, right?
right.
So
Yeah, the interest rate and the tax and that's a very interesting point.
That's hefty. But then that's when we also have other opportunities too, but only, for certain buyers. I know we have, like the all-in-one that we use where it's principal first. So then the interest rate is less of a impact on you, because then you get to do principal first. You can, have your money work for you and sit in the checking account and get credited to it. So you limit what the interest that you're paying on it. And I can get more into that later, but there's definitely different opportunities. And that's when you have to get creative. If you are in the camp that you think rates are going to go up, or you're scared that you're paying too much in interest, then, there are other opportunities out there. If you ask, like, how can I utilize these opportunities to better fit, so I'm not spending so much money in interest? And it's more focused on the home and, paying off my home early maybe, and having, more equity there. But I don't want to go into that. Unless you have questions on it, I don't want to go down that road. That's like a whole nother conversation.
I think we often talk about, it's always a good time to buy for someone.
Yeah.
Right. And unfortunately, for a lot of first-time buyers that started their search 2 years ago and they're looking right now, it's just a reality check. But there are still great opportunities, like you said, to be able to save money on the front end on sales price or something like that, instead of the rates, right? And then if the rates come down, then they're in a good position. The problem is that it's speculation, and no one really knows that. But they're still in a home if they needed a home. People that have cash, and it's a good opportunity for them. It's a really good opportunity, or even have a large chunk of cash and they're just trying to hedge against the inflation.
Well, I mean, think about it too. Like if you're going to buy new construction right now and they're going to give you a lower price, they're going to give you, and it's going to close before the end of the year, because that's where most of these deals are happening.
Yeah.
Like if you can, like, let's say, homes were selling for $550 now. Here's a prime example. I had a client who was with DR. It was like $569 was our contract price. We got it down to $500, and they still backed out, which they're buying cash. So I feel like it made sense to still buy that property, but everybody's different. But my whole point here is, like, if you're in that scenario where they drop the price almost 70 grand, and then you can get them to, give X amount and get maybe a 5% interest rate, right? Like, let's say these builders are actually doing a 4.9 interest rate. Like, you are still way ahead. Even if prices come down, you're still paying more money towards on your principal and your mortgage. You're still spending more money on the principal of that home versus more on interest. And that's where, like, 7% becomes tough, I think, for people. Even me, when I'm looking at, I'm trying to look at other investment properties right now. And I'm like, do I go cash? Do I go a higher interest rate? How much further do I need prices to come down in order to make those right? And I'm sending out to my client base the deal of the week. So if you're in my database, if you've ever come into my website, we're sending out a deal of the week. I'm searching and finding a deal of the week, and we're sending that out to our clients. So if you want to be on the deal of the week email list, shoot me an email. Emails in the chat there, or not chat, but description. I want to get your take on this, Ian and Sarah. So I pulled the numbers. Now, this is kind of preliminary, right? But the median for last month, which was October. So far, what I'm showing now, this will probably change a little bit. We'll probably see a few more closings, but only 692 closings for the city of Austin. For our MLS was 2,300, which, so if we look at pricing going into next year, or like year over year, This is showing us at 588 is the median price. Now, I'm usually on these charts when they come out, they're usually about 15 to 20 grand less. So that still puts us at 555, which is the median of what we've been seeing in Austin, 555. So you're still not, I don't think that we'll see the October numbers drop below 555. What are your thoughts as far as like prices still coming down?
My personal thought is that it's all contingent on how the builders are managing their end of year business, because that's such a large chunk of our numbers. Unfortunately, unless you can remove them, it's gonna mess with our numbers. Now, you had just the city of Austin, so that it's less likely that it's going to be a mass builder if it's Austin proper, but or a lower percentage. But anything in the greater MSA that are outside of the city limits, yeah, it's going to affect them tremendously.
I mean, as far as I've seen like contracts come across my desk, I feel that prices they went down from like the peaks that they were at the beginning of the summer, and they've kind of normalized. I still see some negotiation, but I think that I don't think that, again, I mean, you guys would know better, especially as far as the builders go in concern, as far as what they're negotiating right now, because you probably have clients that are with builders and seeing like how competitive they're getting with negotiating those prices down if they are doing it. I don't see that as much until at the end, but I don't see how Austin could get below 550 personally with what I've been seeing. But that's just, from the pieces that I see. I don't see it all.
So I'll show you. I have, I put together this chart. So this is what I have as far as the Austin numbers. So if we were 555 in August, 555 in September, stayed 555 in October, we're still not going to see negative numbers until December, right?
Well,
so
yeah, we talked about this.
We talked about this last week.
Going parallel would end up happening.
Now, it's possible maybe September's 560, so it pops up a little bit. But does it stay that? I mean, we have a lot less closing in the Austin area. But what you were just saying a second ago is, if we're looking at the MSA, which this is the MSA, do we get below 470? If we get much below 470 now, we are definitely going to run into November's numbers, and when the December numbers come out, we're going to run into negative here. And so this is where you're talking about new construction. All the new construction is mainly happening outside of the city of Austin for the most part. There's a few areas that it is inside, but that's go ahead.
Yeah. So there's that, and there's also the end of year incentives from the new construction specifically. I think that's what's causing, because if they're giving all these numbers, so there's so many variables in there. Are the builders even reporting on the MLS, right? Because if we're pulling this data from the MLS, not every builder is going to be putting that information there, but there's still such a large portion of some mass production builders that will put it on there. But I'm thinking, so if we're looking at these months, October, November, I'm thinking by November, if we're going to have an intersection, that's where it would be.
Brandon wants to know if Sarah can be the third full Migo.
She is. What are you talking about?
She's the honorary third right now.
Thanks, Brandon.
He also said, I mean, obviously, I think this is the question we were getting to. Have you guys seen builders give upgrade money back when they cancel? I've had a couple, yes, but that's only a couple. I just had another one that terminated, and they did not get their $5,000 back. So, and they terminated knowing that. Yeah, I have had others that have gone through and gotten their money back, but it's very seldom.
Right.
I was talking about tax relief. Lost. What was that?
I've had people that have lost. Well, so lost it's a relative word, right? Like they were at this price and they ended up getting something for this price. They walked away from this home because it didn't make sense. But I've had multiple clients that have walked away from tens of thousands because at the end of the day, the other opportunity ended up being better for their wallet.
Right.
Right. And they did not get, the builders were not very forgiving, because I think a lot of them are, you got to think about how the builders treat their business in their times of need. First, it was, do we need realtors? Nah, cut them all out. Now it's, people are walking away. Do we help them out? Nah. Like, we're not going to give them anything back, even if they could be loyal clients in 2 years, or they've bought 4 of our homes. Like, it's an interesting business practice, but I know they're kind of hurting. There have been articles about that, many articles.
Well, I've had GFO Homes just reached out to us and said, hey, come out to lunch. We're putting a lunch together for 10 specific realtors. And Eileen and I's name was on that with some people that you might know from YouTube. I want to get your take. Well, one point of contention here. The biggest problem I find with the unaffordability issue in Austin still is a tax issue. Dinosaur D put this up here. Holy steep Batman, 588 is going to be on a 2.5% tax rate, is $15K a year. The neighborhood I just moved to is like 2.56, right, Sarah? What are we?
Yeah, when we moved in, it was like 2.9.
Yeah.
And then the following year it went down, which was amazing.
Sarah and I now live in the same neighborhood, by the way.
Yeah.
Yeah, we're neighbors.
We're in the cool spot.
But the whole point here is $15,000 a year. If you're making, one of the questions for Sarah was, how much for $500,000 does somebody have to make? I read an article recently that said like combined income needs to be around 130,000 for that. And I'm gonna put out a reel right now talking about the number one group of people that moved to Austin during the pandemic. So you'll see that. It's a good one. Yeah. What I was getting at here is like 15 grand. If you're making 130,000, you're paying 15 grand in property taxes on a 588 home. That's a lot of money to be spending on taxes. It's a lot. And I think that's where the problem is. And in Dinosaur D says that Abbott is talking about tax relief. I really do hope that this is something that they do push for. I think there's ways that maybe we have a renter's tax. So renters are now part of paying some of these taxes. That would alleviate what some of the, what would you feel about a renter's tax? Just curious, because that would definitely pick up some of the money that we're pushing onto homeowners. And that may push people to go, you know what, if I'm already paying a renter's tax, I might as well just go buy a home instead. That way I'm actually making money on it. Right. So what do you think? What do you think a renter's tax would be a crazy idea? I'm just throwing it out there. Trying to come up with ideas.
I mean, so I feel like I can see it both ways, right? Like having investment properties, I can see like as an investor, I'm like, yeah, like I have renters, and it's like it would be great if they could share in that. But that's also why we raise rent to help pay for those taxes too. But then if you look at big picture, not in my specific situation, right? Rent has already gone up so high and it's priced people out already too. And so I know that in itself has been an incentive for some people to buy, but then there's some people that just can't buy. They can't qualify to buy. And then if their payments go up, then where do they go? And they just leave. Like I do see it from both ways, but I don't know. Like I don't know how I feel about that, if that's going to make any sense. I feel like that's why we raise our rent on them. So then they pay.
Well, yeah, I know. I mean,
right?
Every year with property taxes going up as much as they go, I have to raise I mean, for the most part, most homeowners that are renting their homes to people have to raise the rent. And so that makes it tough. And so that's why we saw this year, partly why we saw like a 53% increase in rental rates. Now I think they're coming down a little bit.
So it's interesting that I think that's a unique idea. It's a very unique idea, but I think the downside in my mind is that tax is more permanent, and the rental rates are not. And so if you institute a tax like that, you're raising the bar for people that can afford the area, right? And afford your investments. If it was you raising the rent Again, most investors will not do this. But if there was a situation where, their taxes are going down over time, they've paid off the property, and rental rates go down, they're not necessarily paying more in tax. Especially if they purchased a new construction home and the tax rate is decreasing over time, they're not necessarily paying more in tax. So if they wanted to adjust the rent to make sure that they're favoring a good tenant, they can do that. Where if it's a tax rate, you can't. You're kind of pigeonholed into having to charge more.
Right. But what's pretty interesting is that we're in Dripping Springs, obviously, Sarah and I. Now there's a ballot measure to raise another $460 million, Sarah, for a new school technology, and I forget what the other one, fix middle schools or upgrade middle schools. So I just voted on that, by the way. Here we go. Anyway, so recapture is the biggest problem with our taxes. So a lot of that money goes back. And so that's all money that instead of having to raise, we could lower tax rates if we just push that money back into our schools. But I just left AISD, so I don't trust AISD with my money personally. Anyway, Dinosaur D is saying that Abbott is saying that he's going to send back some of the $27 billion surplus as tax relief. I don't know what cities get that, but Austin is trying to put together to spend more money, taxpayer dollars. In fact, Austin's budget is higher than Dallas's budget, which is a bigger city. We talked about that on here. So they're just going to find a way to spend that on. You give that back to Austin, they're going to find a way to spend that on homelessness. They're going to find a way to spend that on arts or something like that versus like actually giving a tax relief to people.
I don't see that coming to us directly.
No, we're not going to see
never. That would be amazing. I don't see that ever happening.
To change the tax relief, you're going to have to change a lot more. Yeah, I agree. So I got a question for you guys. So there's a lot in the headlines and things that we've talked about on this channel quite a bit, Ian and Sarah, is the amount of jobs coming to the Austin area. Something that we have to start looking at, and we use that as why we think that Austin's not going to crash. Mm-hmm. Well, let's talk about some of these things that are in the headlines then. So number one, we have this. Micron just announced that they are not moving to Lockhart after all, which that was a lot of jobs that were going to come to the Austin area. And we're talking billions of dollars for a plant. They were about $1 billion. I read this article. They were about $1 billion short. Lockhart was getting about $4.5 billion in incentives, and New York gave them $5.5 billion in incentives. So that's why we lost Micron here. But let's look at the next article out here. So you have dozens of jobs for Argo AI shuts down. So they're looking at 78 employees in the Austin area will be infected. So they're losing jobs for this, basically an AI company that's affiliate of Ford. So they're taking their 78 jobs out of the Austin area. You have this article today. CBRE is going to slash their payroll by $400 million. CBRE is big here in the Austin area. Right now, they have, it doesn't say how many jobs they have in the Austin area, but they're one of the biggest managed space renters here in the Austin area. So that could amount to quite a few jobs being lost here in the Austin area. Now they have places in Dallas, they have places around the US. So we don't know how much of that's going to actually impact the Austin area, but that could. And then we have this, the stadium, Kilroy halts construction of the stadium tower in North Austin. Now, if you know anything about this, this is right next to the Austin FC. This was going to go in right there. It's going to be office building, and they're going to put in a bunch of people in there for that. And then we have this article. We'll talk about that one later. But what do you think the impact is with all of these jobs that were coming? We're starting to see more and more articles say people are laying off, or jobs maybe aren't coming here that were going to come here. What do you think the long-term impact is, or even the short-term impact is on some of these jobs stop coming here, or the layoffs in the tech area in the Austin area?
Yeah. Ian, did you want to go first, or
Always Sarah, the guest first.
So, I mean, I feel that we already had so many people move here, right? So follow me on this wacky train I'm on. So I just feel like we had so many people that have moved here already, and there was already not enough more, so more demand than supply, right? There's a lot of people that wanted homes, but not enough supply for them to buy. And I do think that I don't think Austin is going to have a crash, but I think it is unfortunate that we don't have these companies coming here anymore to help create new jobs. But we also don't know how many of those jobs were going to be remote, how many were actually going to employ people here, how many of those people could be potential buyers, how many were going to be renters, things like that too. But I just feel like there's already been so many people that have moved here over the last couple of years where we still didn't have places for them to buy, that as far as that respect, I think it's just going to make it easier for people that are still here wanting to buy. I think that would actually be helpful as far as the overall economy of Austin and the impact of not having those new companies here. I mean, I feel so many companies have moved here, and so many large, big names over the last couple of years. It's been strong. I'm sure it's going to be an impact where we might not have generated income. I'm sure Lockhart would have loved, its smaller area, more income coming in that community if they hired from that community and it directly benefited them. But I personally don't see it as it going to have a major impact on us. Now, if we start seeing this as a trend where other companies start pulling out and moving, then that's another conversation.
One industry that's starting to hire more is the hospitality industry. So there's something to think about too, is that a lot of these jobs that were tech jobs, that were all these other jobs, now you have 2 years where people weren't traveling to Austin as much, but hospitality is hiring like crazy right now. So that is an area where, and they're still short staffed. I was trying to find an article. There's still 100,000 this was about 2 months ago, or no, about a month ago, there was still 100,000 open jobs in the Austin area. And I'll pull up in a second, the unemployment's still under 3%. It's like 2.6. So I think you're right. In an aspect, if somebody wants to take anecdotal evidence and go, okay, there's a bunch of jobs leaving the Austin area, that's great. But there's still not, let's say it's 2,000, 3,000 jobs. You still have 98,000 open jobs, right?
Yeah.
I think there are a couple of things to look at that people often tend to overlook. One, a lot of these companies came here for a long-term benefit of having a relationship with graduates, specifically from the different colleges, being a feeder town, right? And so even if it's talent, really. And I think Austin still has the talent, but if you look at it from a business perspective, is it easier to acquire new customers or existing customers? And we're looking at these graduates as existing customers. They're already here. There's already an opportunity. So can Austin retain some of these graduates? If so, that could be a good opportunity. The second thing I would like to look at and pay closer attention to is vacancy rates for apartments. We have a lot of apartment complexes that have been going up all over the place. It is crazy. We've needed it, right? That might bring down rental rates and all that, but what it doesn't do is cause people to leave, right? If they can get an apartment easier, they're going to stay and they're going to need jobs. But what is the vacancy rate? Is it like, these apartment complexes that are being built, are they on waiting lists still? Are they at 70% occupancy? That would be really bad. Most of them, from what we remember, we're sitting at 98% occupancy.
Yeah.
So as those rates start to drop, and then the desirability of the programs at the different colleges nearby, I think that's when we have to worry. In addition to the jobs, it's almost like there's a trifecta there. The jobs that are leaving don't really worry me. I think one of them is a real estate firm. We all know that real estate, it'll be picked up by somebody else. That's fine. That's not going to go anywhere. There was Micron. They got a better deal, but I don't know if that was short-sighted or greasy palms. We don't know. We don't know what the true reason is behind that. We hear $1 billion, or is it $1 billion difference? That's what we hear. But it's New York. They're going to tax them to death. And there's so many, what other again, I don't know this, but what other chip manufacturers are collectively growing a presence in New York that where Micron was like, oh, that's a good idea.
Yeah.
So just a lot of things to look at.
Well, I mean, a couple of things. The average buying age is 33. I just posted showed an article that we had more millennials moving to Austin net than any other city. So that's really important to think about as well. So there are a lot of people in that buying age. Are they going to buy? Now, a lot of people in the comments keep saying that Austin's unaffordable. So California says there are more badly paid jobs than good paying jobs in Austin. I'd like to know where you got that info.
Well,
And then Austin isn't affordable for the wages being offered. Now the
but
median,
compare that to New York.
well, the
and
median
compare that to
income for the
California,
Austin
right?
area is $98,000. So it is quite a bit higher than compared to Dallas. In fact, if you look at what's more unaffordable, Dallas is actually more unaffordable than the Austin area. So that's something to think about. And people don't realize that because the incomes in Austin are higher, no matter what people want to say or anecdotal evidence they want to say. If you go to the Chamber of Commerce website, it does show that Austin is the highest income. So, I mean, what are your thoughts there on that as well?
Yeah, I think if people do all of the math, I mean, some people do all the math. Other people end up here. We talk about love or money. It's circumstantially, but I think if they do all of the math, then Austin, I'm not saying it's affordable, right? I'm not saying that. I'm saying that it could be put them in a better position than a lot of these other cities. That's it. So I still think Austin has quite the draw, especially in comparison to something like Dallas or New York.
I mean, here's the trends right now. For September 30th, it's saying that the MFI is 110,000 for Austin.
Yeah, and I got to be careful when I say New York. I'm talking about like Manhattan area versus because Micron was upstate, right?
Yeah,
and that's a very different feel. That's what is
Yeah.
that? Pennsylvania essentially, or Jersey, or where? I don't know, wherever it was. Pennsylvania.
Such a weird looking state. So John S. earlier had said, good to see the Real Migos 2.0. What defines the market crash in our community? Homes were selling in the mid 900s 7 months ago. A couple homes sold recently in the mid fives. And he said that was Trento and Cedar Park. New York is amazeballs. No, I don't think so, Christine. That's a lie. I was just there. It's not as great as people.
Yeah, it was just there.
Ian and I did not have the best pizza while we were there.
I know. What? Like, wait a minute. What? How do we go to all these pizza spots and we don't get good pizza? I'm from Chicago and I'm sitting here like, New York, you can do better.
Somebody took us to a Mexican restaurant. I'm like, what are we doing here? Can we go to like Italian food? Like you can
You don't get Mexican food in New York when you're from Texas.
You should be able to get anything. It's such a big city. You should be able to get anything.
Yeah, and the Mexican food was Jeremy starting pizza. I'm not saying New York doesn't have good pizza, but the places we went sucked.
You're gonna start getting like mail ordered like pizza to your dorm to be like taste tested.
As long as it's not like Kristina. Kristina was getting somebody was sending her Domino's to her door during her live streams. That was kind of funny. Not funny, right, Kristina?
I remember when I was in.
You got to go to the Mexican restaurants for the best pizza. What?
That's your problem. You don't get pizza.
Kristina is a Yankee for sure. Kristina, how are you doing? I quoted Kristina in my video that came out Tuesday, which you should go watch if you haven't. Dancer D's, just don't ask for a fruit salad in New York. I don't know what that means. So anyway, so back to our points here. So wrapping up a little bit here, Sarah. So we don't know where rates are going to go. Do you think, and I don't think you even answered back to our question a while ago, you know, Ian and I were saying, somebody's saying rates are going to 10%. There's an article saying they're going to be 5.4. What do you think, Kristina, in the comments? I think just did a video on this. Where do you think rates are going to go, Kristina? But Sarah, let's hear from you. Where do you think rates are going to go by the end of this year? And then where do you think they are next year?
I think by the end of this year, we're probably going to see them teetering around the same amount. I think that we're going to still be somewhere between like the mid 6s and like 7% or the low 7s. I don't think that we're already in November. I don't see us having very much movement between now and the end of the year. I do think next year we have an opportunity to get back into the 5s. I do think that. But it depends again on what the Fed decides to do. And then having those inflation numbers come out. And by March of 2023 is when we'll finally, in our cash surplus, our cash supply, we'll finally have the stimulus money out of all of our numbers. So I think as of March 2023, then we're finally going to be able to use like real numbers and what the economy's doing as far as calculations are concerned. So I think that's when we'll start to see where we're really at as an economy. And I think that we should start seeing that inflation because it's delayed, right? The Fed is always looking at past numbers. So I think by the time we get to spring of 2023, we should start seeing where we're truly at, where inflation numbers are really at. And I think we do have an opportunity to get back down into the fives if we start seeing, those inflation numbers come down. So I think there's an opportunity, but there's a lot to be said. We don't know what's going to happen, politically, globally, and, stateside. We also, other things could happen between them, but I do think there is an opportunity to be back down in the fives next year.
Interesting. Kristina says here the rates are going to be at 5.5% by the third quarter next year after hitting 9% at the highest point.
9%.
9%.
That's hot. I will say though, if you're looking into like non-warrantable condos that you're not paying cash for, something like that, you're already there. Yep. Like if you're looking for those atypical properties where you have to get different types of financing, you're already up there. But I don't know, 9% is kind of steep. I don't think that by the end of this year, I think it would be really hard. I mean, I don't foresee it getting that high. For if you're looking at like a standard traditional.
I hear a pizza bet coming on.
Yeah. What are rates? So usually it's a little bit higher, but for investors that are trying to buy right now, what are you seeing on average for rates for them? Is it a 0.5 higher, 0.75 higher than standard rates?
Yeah. I mean, it depends on what we're doing. And I know this isn't like the ideal answer everyone wants, but it's not usually like, it just really depends on, what the market's doing the day and what's pricing is. And honestly, a lot of my investment properties, I'm doing like the all-in-one loan for it. So it's entirely different because it's simple interest, not amortized interest. And it's just a different type of product. And that's currently starting out like in the low sevens. So low mid sevens. I haven't seen many people want to do a standard fixed rate on an investment property lately because it hasn't really made sense. And usually it makes more sense for them to do this other loan product. But I would say that you're probably looking at high sevens if you're looking at traditional. And
see, that's tough for investors. Ian and I helped quite a few investors last year, and to go from, I think, what did we pay on one, Sarah? Like 3.25, paid 4% for another, something around there. I mean, now I'm looking at, and we had to lock in on that last one way early because it kept getting pushed out. But I couldn't imagine what my mortgage would be. I mean, I would not be making anything on, not even covering anything if I was at 7.5% for my investment loan on one of my properties. But Kristina, I remember you talking about over 5%. People on your channel did laugh at you. I don't know that I laughed at you, but for the longest time, we didn't expect rates to be over 5%, and then they were. And so what's interesting is like I'm kind of done like making predictions. I'm only telling people what we're seeing right now because on this channel we said that prices weren't going to come down. Now prices year over year is still up, but when we get into next year, we talked about this, they are going to be negative next year. I don't see, you tell me if I'm crazy for thinking that we're not going to see prices come up from 470 over 550 by April of next year. I just don't see that happening at all. So we're going to see months of negative numbers next year. What are your thoughts?
That's interesting. I mean, if we do keep rates high, though, that's going to help offset, because that's the only way that you can offset, where you have a buyer is like when you have higher rates is having lower prices. So it kind of nets out to the same price, monthly payment for people to still be able to buy.
Right.
But that's the whole goal, right? Raise Fed fund rates to, make the economy slower. And this is what we're saying.
Yeah, I mean, the thing with raising the Fed funds rates just means, for the most part, that most businesses are going to have a harder time borrowing money. So they're going to have to lay off people. So you are going to see a lot of layoffs coming, especially, the beginning of the year. We're talking about a recession in the beginning of the year. A lot of it has to do with all the things that we've talked about. So I think it's really possible that this thing is going to get a lot worse. And so I think Kristina could be right that we get up into the 9%. Are we over 10? I mean, there's probably going to be some people that are paying 10%, depending on their scenario. But, I think you will see a lot of layoffs, and I think you'll see a lot of layoffs in the tech industry. You'll see a lot of layoffs in the service industries. So, man, the question is, should I sell my Airbnb in Sal Padre? Anybody want to buy an Airbnb in Sal Padre? $300,000. Two bed, two bath.
That's a sidebar.
Square feet. What was that, Ian?
I said, that's a sidebar. I was looking for one of those. I was like mad that you got it. I mean, not mad, but like, oh man, I really wanted that because you can see the rockets. You can see the rockets launch.
You can see the rockets launch.
That's crazy.
I'll, and if you are looking for a 55 and over community, I got a cool listing up in Vizcaya right now. But all right, there we go. That's it. Last words, Ian.
Date the rate. No, I'm just kidding. That is not it. I think my question for most people would be, what do you think the intersection is going to be where the sales price meets where it was last year? Do you think it's going to be this month? Do you think it's going to be December? Do you think it's going to be early next year? Or do you think it'll never meet that number and start to rise back up?
I mean, I think at the beginning of the year, if we see rates, like let's say the beginning of the year, January, rates go from 7.5% and they drop down to 6.5%.
We're letting them answer.
No, hold on. But I'm just saying, like, let's say hypothetically, like rates drop down 1%. Is that going to force people to jump back in, or are they going to wait for rates? They're like, oh, I want rates to come down even further. And so what's interesting is we have a lot less people buying homes right now that we could see, because of that, we could see rates come down. At what level do people finally go, okay, now I'm buying back in, when they could have bought a home now for 6%, but they're going to wait till next year to buy a home? And how much do prices come down? I think that's where the curiosity in me lies. But I think if you see rates drop down to 5.5% at the beginning of the year, the whole market's going to flood with people buying back again. So So I think those prices will come back up. I think we'll probably be in the MSA. We're at 470 now. I think this month we'll probably be at 450 when the numbers come out. I don't know that that's true, but I mean, I'm only seeing it go down for the MSA. So, I don't see it all next year. We see positive numbers, possibly.
Ooh, end on a sad note.
Yeah. Speaking of one of our favorite YouTube channels, I'm not going to say it. They're leaving to go back to be. I don't watch the channel. Somebody called me to tell me this, that they're leaving YouTube and they're moving from Dallas, renting in Dallas, to moving into with their mom in New York and closing down their YouTube channel. That's what I heard.
Oh, really? That was real?
That was real.
Oh my gosh! I thought you were trolling me.
No. I wasn't trolling. Somebody called me like, "Oh my God, did you see what happened with your friend over there?" And I'm like, "I don't watch the channel. Tell me."
So one real quick note on this right here: the people going to be patient and see how much they can drop. I think right now you still have people that are just now, like just today, saying, "Oh, I want to buy a house," right? And they don't even know what happened 2 years ago. They're hearing about it, but they don't really know. And so you have these new generation of buyers that weren't pandemic buyers that will, I mean, that at that point, it's based on what they can afford, right? But really, they're not sitting here evaluating, well, 2 years ago, I could have done this, because that didn't matter. They weren't buying 2 years ago.
I think that's what's really important, though. I think at the end of the day, like, if you want to buy, but it has to make financial sense for you. I feel like there needs to be, yes, rate is a factor, but why is it a factor? Why do people care? Because of payment, right? At the end of the day, when people ask about rate, they really want to, most of the time, they really want to know about payment. So if that monthly payment makes sense for you, you're comfortable with it, then I'd say, then go ahead and buy now. Don't sit on the fence and wait, because we know how that played out at least I've seen how that's played out in the past. And typically it's not for the better for waiting. It ends up being negatively affecting them. I'm not saying that's always going to be the case by any stretch of the imagination, but if you're comfortable with the payment, it makes financial sense for you, then I say move forward. Don't be scared that you're going to miss out on some future opportunity, because you can always refinance if an opportunity does present itself. But like Jeremy said before, if you're not comfortable with the payment because of the interest rates increase and everything else, then maybe that's not the best opportunity for you. And Ian said it earlier too, like it's always a good opportunity to buy for someone. So I say, don't get scared because of interest rate. Focus on what's important to you, which is going to be the payment. Does the payment make sense? If it's investor due cash flow, if it's a primary, does it make sense and fit in your budget? And besides that, don't worry about that other stuff. I think it kind of just adds on a bunch of stress where it doesn't need to.
Spoken like a true lender. I'm just kidding. You're awesome. I'm just messing.
All right. That's it. Love y'all. We'll catch you next week on Real Amigos. Drop what you want to hear next week and we'll put together